This video will explore how market analysis help investors understand the relationship between the economy and security markets and how these insights guide smarter investment decisions. Good day everyone, I am Roxanne Datulaita.
And I'm Nika Api.
Today, we'll discuss the components of market analysis, a very important topic in investment and portfolio management.
That's right. Understanding market analysis helps investors evaluate both the economic environment and individual securities before making investment decisions. It helps them manage risk and maximize returns.
To begin with, can you tell us about what market analysis is all about?
Sure. Market analysis is divided into two main components, macro analysis and micro analysis. Macro analysis focuses on the overall economy. It studies how the market reflects economic activities, inflation, and interest rates. And microanalysis, on the other hand, builds on these ideas to determine the specific value of a market or investment using valuation approaches.
Let's start with the macro side. What does macro market analysis include?
Fluctuations in the security market are usually linked to changes in the overall economy. Prices of bonds and stock move depending on interest rates and inflation, and there are four key parts of macro analysis. 1. Relationship between the economy and stock prices. 2. Economic theories that provide insights about the market. 3. The macroeconomic effects of inflation and interest rates on security prices. 4. Other global factors that affect world security markets.
How exactly are economic activities related to security markets?
There are two main reasons. The first one is the stock prices reflect expectations of earnings, dividends, and interest rates. The second, the stock market reacts to leading economic indicators like corporate earnings, profit margins, interest rates, and money supply growth.
I've also heard about the cyclical indicator approach. Can you explain that?
Of course. The National Bureau of Economic Research groups economic indicators into three categories. First is leading indicators, predict changes before they happen, like stock prices or new business orders. And the second is coincident indicators, move together with the economy like GDP or employment. And the third is lagging indicators, change after the economy like interest rates or debt levels.
So these indicators help markets analysts predict market trends. But are there any limitations?
Yes, there are. Sometimes these indicators send false signals or the data may change direction suddenly and making them hard to interpret accurately.
Now let's talk about inflation and interest rates. How do they affect securities?
The relationship between interest rates and bond prices is negative. When interest rates rise, bond prices fall. For stocks, the connection is more complex. Inflation and interest rates influence discount rate and future earnings expectations, which then affects stock prices.
How does monetary policy come into play?
Monetary policy impacts stock returns because it influences money supply, inflation, and interest rates. Analysts often use valuation techniques like dividend discount model, free cash flow to equity, earnings technique, other relative valuation.
What about estimating corporate profits? How is that done?
There are three main procedures. One is net profit margin based on recent trends. Second, net before tax profit margin measures profit before taxes. And the third one is operating profit margin, earnings before interest and taxes as a percent of sales.
And what factors affect aggregate operating profit margins?
four major factors. Number one, capacity utilization rate. How much of a firm's capacity is used? Number two, unit labor cost. The cost of labor per output. Number three, rate of inflation. Overall price increase over time. Number four, foreign competition. Effects of international trade on local businesses.
To summarize, market analysis is a vital part of investment management. The macro market and micro market approaches help investors understand how the economy and individual securities perform.
Exactly. Knowing these components allows investors to make smarter decisions, balance risk and return, and react better to changes in economic conditions.
Through this topic, we learned how important it is to connect economic indicators with financial market.
As future investors, we need to understand that the market is not just about charts or random price changes. It reacts to real situations. For example, imagine the government increases interest rates. What usually happens? People borrow less money, businesses slow down, and stock prices can drop. If we understand this relationship, we won't panic. Instead, we might shift to bonds or safer investment because we know they perform better in high interest rate periods. Also, think about global events. If there's a war or oil price increase, the stock market might become unstable. A knowledgeable investor doesn't just guess, they analyze the situation and adjust their investments. When we understand both, we don't just invest blindly or follow hype. We make smarter decisions, avoid big losses, and take advantage of good opportunities. And as future investors, understanding these relationships helps us analyze opportunities more effectively. That is why, as future investors, understanding these relationships is very important. It prepares us for real situations in the market, helps us manage risk, and give us confidence when making investment choices. Because, in reality, the market will not always be stable. There will be times of recession, high inflation, rising interest rates, financial crisis, pandemics, or global conflicts.
Thank you for watching our videos on the components of market analysis.